Good morning, everyone. I'm Vince Lancy. This is the GoldFix Market Rundown at 7:29 in the AM Monday morning, Thanksgiving week. We have many stories to touch on. The main story isn't even on the page right now. We've got so many good things that have been happening news-wise. But the main story is Deutsche Bank says governments are now buying gold by the ounce, not the price, implicitly, creating relentless demand that could redefine the global monetary system. Before we get to those and many other stories, let's take a look at the markets. 10-year yields are down 1, almost 2. The dollar is down 13. The S&P 500 is up 21. The Nasdaq is up 10 to 11. The VIX is a little softer, about 50 basis points. Gold is up $7 on the highs of the evening or the morning so far. Silver is up 12, 13 cents, so it's 40.71 in gold and 50.11 in silver. Copper is 497, unchanged bid. WTI is 58.11, up a smidge. Natural gas is down 6 cents. Significant, but given the rally that it's had, that makes a lot of sense. Bitcoin had a strong weekend, but is down 600 points right now, trading 86,000, well off its lows, but nowhere near where it was before. Ethereum is up a little bit, about 7 points, 2,800. Palladium is up 9. Platinum is up 21, 1386 and 1534 respectively. Gold, silver hovering at 81, and grains are all weaker with wheat leading the bunch lower. Okay. Main story. Deutsche Bank says sovereigns are no longer buying gold based on price, but on predetermined ounce targets, signaling a major structural shift in global monetary behavior. Governments are effectively printing whichever currency is needed to secure metal, creating persistent, inelastic demand. That's the key phrase, inelastic demand, that lifts the floor under gold. Deutsche Bank argues reserve managers will keep accumulating through dips, while jewelry and ETF flows play a secondary role, even though the ETF flows themselves are now seemingly somewhat inelastic. If this trend holds, gold's rise is far from over. We would also add that this vindicates something that we observed a year ago when we were doing some analysis on India's gold demand. And we noticed that since 2022, India's demand had been the same amount of ounces per year, regardless of the price. So they're buying ounces. They're not budgeting money. And that story is titled Sovereigns Print Fiat to Buy Gold Now. And you can find that in premium. We have a bunch of other stories. We want to just touch on them to let you know that it has been a busy weekend starting Friday for the metals as well as for us. First, something on COMEX is really rotten. This is our analysis. A surge in massive unexplained revisions to COMEX gold open interest is raising red flags with us about hidden losses, market stress, and the integrity of America's key gold benchmark. Rich Dad Kiyosaki sells his Bitcoin despite assurances he would not do that. After vowing he'd, quote, never sell, end quote, Rich Dad author Robert Kiyosaki, dumped over $2 million worth of Bitcoin and shifted the money into real-world cash flow businesses. For the founders, one of the posts we sent to the founders was a breaking story and something we'll share with premium as soon as we develop it a little bit more. But basically, Europe and India just agreed to bypass the US dollar in cross-border payments by linking their instant settlement systems, marking a major step towards regional reserve currencies with a special mini-pod broadcast. If you're wondering what that is conceptually, when you go to the bank and you want to transfer money, forgetting Venmo and PayPal and all those other things, and even Zelle, when you do a drop down, it says, do you want to do a wire? Do you want to do an ACH debit? Well, now it's going to be, do you want to do what we have, which avoids SWIFT altogether? And that'll be something that retail will use first, and then institutionally will be mandated from the top down as people get acclimated to it. Next, UBS raises gold to a 4,500 to 4,900 for 26-27. UBS just lifted its gold forecast to as high as $4,900, calling the metal the strongest global asset and a critical hedge as geopolitical and fiscal risks mount. Hartnett, Bitcoin is the tell for 2026 Fed policy. Bank of America's Michael Hartnett says Bitcoin is the tell for 2026, arguing its slide is the first clear signal that liquidity is tightening and the Fed will soon be forced to cut. We would add Michael Howell at Capital Wars has been talking about the liquidity issue and the liquidity cycle and Bitcoin's relationship to it for uh, a reasonable amount of time. And it certainly makes a lot of sense. It goes to the concept of Bitcoin is a tech behaves more like a tech stock than a store of value. At least, at the margins it does. When the liquidity cycle turns, Bitcoin gets hit first. And stocks got hit first as well, but stocks have bounced magically, but they've bounced. Again, for the founders, how the market keeps us honest. A veteran CIO explains why the old line, more buyers than sellers, is real wisdom, not sarcasm, and why markets often move hardest long before the reason becomes visible. Why is the market up today? More buyers than sellers is the old joke, and people think that that's sarcasm. It's really not. It's we don't know why. We'll find out after the fact because, in a sense, traders are traders not in the know are mushrooms kept in the dark and fed a lot of shit, and we find out after the fact. Next, a couple more stories, I think. Italy's gold tax, pay now and pay later. Italy is moving to tax and track private gold holdings, unveiling a voluntary amnesty that could transform centuries of family wealth into a fully monitored state asset. That's no bueno or no bono if you're Italian. Uh, that's authoritarian government. Finally, gold and metals producers anchor MSCI's latest China edition. China's major stock index is being reshaped by a surge of gold and metals producers, with, if I can say this right, Zijin Mining leading a wave of new additions that signal Beijing's growing tilt toward hard asset power and dictating important assets from that part of the world. Russia expands gold operations as domestic liquidity rises. That's our news and explanation of why it's not bearish for gold. And in the chat, well, we discussed several things, but it's very lively and a lot of participants, and there should be a lot of content to be put in there from the Sunday broadcast when we send that out later this morning. And data on deck today, there's nothing scheduled. Let's clean that up. That's better. Tuesday's retail sales. Tuesday's PPI as well. Wednesday is initial jobless claims, which happens every week, durable goods orders. Thursday is Thanksgiving in the US, and Friday is the Chicago Business Barometer, which is PMI. That's it. Take a quick look at the charts. See if anything jumps out at us. So starting with gold, we are in the wedge. The old adage was if you're trading gold, you're trading wedges, meaning there's always lower highs and higher lows, and the market hits a wedge and breaks out of it down in the old days. But now it might be breaking up. I wouldn't call this a wedge yet, although it certainly is a wedge, but I think we're going to have a lot more of that. We'll see what happens on the other side of it. That's the 30 and 50-day moving averages. The 40-day does seem to be governing this. Hat tip to CEO Technician. Let's pull up our lines, the lines that we drew going back and the new ones, and see how that fits. Remember, we contend it's a trading range now, just like the one that started in April. It's not 4 months long yet, but you won't have the benefit of that until it's in hindsight. We're just saying the chances grow that it is a sideways channel. And there's our lines, right? Okay, so just to recap, this is the support that matters, 39.14, and this is the resistance that matters, 41.68. And in that area, we're going to trade a range. We're going to extend it outside. This was important to us before. This was if the BIS or someone large put a cap on this rally, as is their responsibility when the market gets crazy, and then the market stopped here and dropped, well, that's an echo. Could be the same player, could be someone else, doesn't matter. And so that defined the range from here to here, from here to here. And I did say when we get above this line really shouldn't matter and we should go to here, and we did. But frankly, I got bullish-er because we got above this. And of course, it reversed and went down. But we're in a range. It's not a big deal. And I'll tell you what's very encouraging. What's very encouraging is that this line, which shouldn't matter, I think I did this like 6 months ago. This line, which shouldn't matter, seems to matter. And I say that because usually when a market overextends to the upside of a range, it will overextend to the downside. I think it's extremely encouraging that the market did not go back down to this area and retest it in short order. Implicitly, the floor is being raised again. So here's your range from 39.16 to 41.59, give or take, right? When the market gets overbought, it needs to work off being overbought, and that means it might go down all the way to 39.16 or so again. However, it is stopping or at least pausing in this area here. That's encouraging. That says to me, whoever the buyer was down here may in fact be buying up here now. And that buyer may be a bullion bank, it may be a new buyer, maybe Chinese order flow. It could be anyone because we have a real dynamic market now. So if we do get below here, I think you're going to see some buying in this area here, and this might be front running of that buying. That's it. So we're in a range. Don't get too excited because it is buy season. You want to be bullish, but we just had a tremendous bullish sell season. So be happy where we are. Silver, judging from my lines, it's above lines that matter. So maybe I should be thinking about it the way I think about gold and pop a line in there that looks like this. Now, I didn't see this before. I should have, though. Yeah, so you could say we're in this range now. And if we break it, we can go all the way. I'm going to move this. I'm going to move this up now. I'm going to raise the floor myself. Okay. And I'll leave that there. And that's it. That's our range. We're in the middle of it. Silver strong. Silver stronger than gold. I mean, China's pulling its silver off the market. LBMA is leasing silver. Turkey's silver imports are spiking again. I think I'll share what I think. China is really smart. And throughout the last 30 years, anytime they got out of line by manipulating their currency, they were called on it by the US, which used the UN or used the IMF or used the World Bank as its proxy. And China immediately would back off and say, we're not manipulating currency. We're not manipulating currency. China is a honest player publicly. What they're doing in private is a completely different story. And the reason that gold and silver, especially gold, but now moving into silver, are so important is because the US and the G7 do not consider them money. And because they're not considered a global currency in the FX market, you can't manipulate them. It's a global commodity. And so China and Turkey and India and anyone can do whatever they want, and the US cannot accuse them of manipulation because it's not fiat, it's not a government controlled asset. It's a global asset. And the thing that has weakened gold for almost half a century, the fact that it's just a commodity, it's not a currency, is now uh, ironically the thing that is undermining the West's ownership of it. Can't manipulate a commodity if it's globally traded, can you? Well, that's what's happening now. And now, as gold is being remonetized in the East and silver is going to follow suit in the West, we're still struggling with it's just a commodity, just a commodity, and that will be our demise. All right, I'm Vince. Have a great day.